Hello and welcome to Talking Technicals, the show that helps you get your hands dirty with technical analysis. It helps you fill in a lot of blanks in your trading strategy. By what, by when, by how much, sell what, sell when, and why. And when you book your profits and when to cut your losses. Wow, that is a lot of blanks. Not sure if you should be trading with so many blanks. Maybe you already know half the answers, but the rest is where we will help you fill those in. So let's get down to business. The first chart for you coming up already on the show, and I thought DLF would be a good one to look at. Why? Because its last quarter results disappointed the markets and caused the stock to actually correct sharply downwards. So if you look at the chart of DLF, you will see that on May 25th, where the results came out and the stock was down 10 rupees on that day, it went down to 210, and that too on huge volumes. So now you're looking at a stock which is at its 52-week low of around 208, far away from its high of 400. Are you tempted to buy it? Can't buy a stock just because you feel like. Let's say what the chart says. Is it a buy, a sell, or a hold? Well, to answer that question for you, we have our expert guest on the show, Dr. C.K. Narayan, who tells you all about technical trading on our daily shows and now a little bit more about really the mathematics and science behind it. Doc, we're looking at the chart of DLF. What would you recommend?
See, DLF is something which gave us very, very contrary signals on the charts as compared to the news. See, when the results were announced, it seemed like they're not really fared very well. Everything was skewed towards costs, etc. And you had this big move on the downside here. But subsequently, even when the results were actually analyzed, the market actually took it otherwise and kept moving higher. So here is a clear example where the news is indicating that the prices should move south, but actually the share actually moved north. And that is a clear indication that you must pay more attention to what the market is saying about what the results are than the results by themselves. It's the news which is not important. It is the reaction of the market to the news which is significantly more important.
That's really important, because you might have your own gut feel and say that this is what the market is, this is what I feel, this is what I feel. It's irrelevant what you feel. It's really what the charts are telling you, and that's all you have to do. Pure science, a little bit of art. But last week we had suggested that you take a look at the Nifty chart and give a 1 to 2 week outlook based on the moving average indicators that we had learnt about. Let's get Dr. Narayan to take a look at the replies we got and see who came out a winner.
Hi, first of all, I wish to thank everybody who wrote in and sent us all your analysis. It was really very, very encouraging. From the list of replies, I have actually picked a reply sent in by Mr. Zubin Zaveri of Bombay. Now, the reason why I picked it was that, he's actually gone about it in a very, very, very nice structured way. He has looked at moving averages. He has looked at, even though we have not covered it, he has looked at oscillators. And he has looked at the resistance, for example, in the Nifty at the 200 EMA. He has also given a certain logic for why he looks at, his view has been bearish and the market has indeed been slightly bearish across the week. So I think the way that it has been laid out by Zubin has been extremely good. He has also done a fairly decent job with respect to his views which he has expressed on Infosys. Lots of others also wrote in about Infosys, but then I think most of them missed the major setup which was there in all the charts, particularly the head and shoulder pattern at the top. You see, this is a pattern which could not have been missed, and you had this huge downside gap also which was actually created, breaking the neckline. So if these two things have not been mentioned by many people, which is why their analysis has not been featured. So I think Zubin, having mentioned all of these and also made a logic for the target. Many of you have mentioned various lower level targets, but I think you have all mentioned it without really giving any logic for it. What we are looking for is something which lays down the analysis, which says as to how you have arrived at a certain view. Then you will of course give a target or what is your expectation ahead. For that also there should be a logic saying that if you expect the Nifty to go to 5350, like many of you have written, why 5350? Do you have a trend line there? Do you have some sort of support there? Unless it's really accompanied by some such set of logic, it becomes only, it's only a guess. And we are really not trying to guess here. We are trying to analyze something, and that is what I really want to see. So, as I said, Zubin Zaveri from Bombay is the winner of last week's quiz.
Today we take a closer look at interaction between moving averages and learn about the moving average convergence divergence line, that's MACD. Don't worry, it's not too complicated, a little complicated but not too much. And moving averages, of course, let's quickly go back to that before we come to this MACD. So moving averages, as the name suggests, is the average of the stock price over a given period of time. So say 10 days, 50-day or a 200-day moving average. And let's see what it looks like on the chart of crude oil. Let's pull that up for you. And why crude oil? Well, because crude has actually been showing a lot of strength over the last couple of months, and you've got all the big banks upgrading price targets on it. Goldman recently increased its crude forecast from 107 to 130, and Morgan Stanley raised it by 20% to $120. So let's get back to the chart there and let's impose those moving average lines over there. So we can see that 10-day moving average line on the chart. That's pretty much going very close to the actual crude price that you can see, and you know, the crude price, if you see, it looks like these bars all along, which are actually the candlesticks which show you the open, high, low and close on every day. And add on to this the 50-day moving average line, which is the one that you can see right now. And finally, you will see that the strength in crude is coming because the 10-day moving average is actually pulling up the 50-day moving average up with it, as also the 200-day moving average. So basically, if the short-term trend is very steep and strong, it will actually pull the long-term trends up with it faster. And the final evidence of the pull is when the daily moving average line cuts the other one. That's what's called a crossover. We spoke about crossovers last time. Just see the crossover once again on that crude price chart, and you will see the strength coming in. Dr. Narayan, did I give a fair analysis of the crude chart?
Absolutely, Damini. You can see on the chart itself. Here you have a fairly clear-cut sort of crossover on the crude oil chart, which then subsequently led to this nice, strong upside rally, which lasted across at least several weeks out here, prior to showing you a negative crossover right here. So if you had entered long at a level around 88, you would have actually gone and had a run till about 114. So that's a huge amount of move, based on the sort of crossovers that you had.
So let's look at some more crossovers, and I think another interesting one is the Reliance crossover, where you're looking at the 10-day and the 20-day moving average crossover.
Yes, if you look at the chart of Reliance, it is, at the larger level, it's been largely within a range. But if you use something like a 10-day and a 20-period moving average, you see this periodic crossovers here, which is negative, and the market had a downfall. You had a positive crossover here, and the market had an uptrend. Similarly, out here for a negative, here for a positive, and so on. So every swing of this particular share could have been easily traded or profitably traded if you had switched to moving to using a 10 period with a 20 period crossover.
And are there times when a moving average actually gives no indication at all?
Well, the moving average gets into some sort of a set of problems when it actually gets into a sort of sideways range. Now you have two sets of things. One is where it moves into a sideways range and the crossovers happen frequently. And the other could be another sort of example here when you don't have a crossover at all. So whether there is a crossover or there isn't one, in both the cases moving averages will give you a very good clue. If you take a chart of TTK Prestige, which is what I have on here, you can see that there has been hardly any crossover of moving averages. They just come together and then they begin to diverge again. This is what is the beautiful thing about using moving averages on long-term trended stocks. They make you stay in the trend for very, very long periods of time. As you can see here, many, many months that one could be long in TTK Prestige from the price of around 800 and it's now trading at 25.
Because there's no
and
need
you
to do
stay in
anything.
it, and even as right down to this day you stay in it.
But talking about moving averages, of course, we know that you can have them over different periods of time. You can have the average over 7 days, 10 days, 50 days, 200 days. So which time periods are really the most important, and does this actually also depend upon the time duration of a trade? So for instance, for a day trader, would he be looking at different moving averages as opposed to somebody who's in a trade for a year or two?
Well, I would put it a little differently in the sense as to what is the trader wanting to know from the chart. If you're going to be an in and out day trader, you would want to use smaller period moving averages because you want your signals sort of firing at you very frequently.
So what periods would those be?
So I would say anything which is less than 15 periods would be ideal for such a thing. You don't want to really go much out of 15 periods.
And
so anywhere between
like?
5 and 15. Like if you take in this chart, I have two sets of averages here. Here is something which tracks it much closer. So anybody who wants to go in and out of the stock should use a smaller time frame. But somebody who is using it largely as a kind of a support mechanism will have to use a longer period moving average. So it really boils down to what is the kind of usage that the trader wants to put the tool to. You want in and out trading, use a smaller period. You want more leisurely set of signals where you're using it largely as support or resistance, use a larger period. So whether you're a short-term trader or a longer-term trader, it's really dependent on how you want to use the tool.
10, 50 and 200 is good for positional traders.
You could probably split that up into a very short-term trader, a medium-term trader and a longer-term player, right? So I think something like that. See, it really depends upon also how the market is. If the market is moving very swiftly, then we would actually like to lower the time periods. But if the market is very languid and leisurely, then we want to actually move it out a bit. So we need to be a little aware of the tool itself. You need to know the tool. That's the main thing.
Well. So, what we've seen is that interaction between the moving averages is actually very critical to determine trends, and this brings us to the moving average convergence divergence line. That's really long, MACD. But, what the line really does is tracks whether the moving averages are actually coming closer or they're growing more and more apart. So, what does this line do? The line actually plots the difference in value between two moving averages. So most commonly used numbers are, say, the 12-day moving average and the 26-day moving average. The two values that you have, you take a subtraction of the two, and that's what you plot as a line. That's your baseline, and then you have a 9-day moving average of this MACD, of this line that you just plotted. You plot that as well. And the crossovers between these lines, those are the ones that give the buy and sell signals. Actually, you can see that plot right there on your chart, and I can say that to you again, that basically the MACD line is the line which plots the difference between the 12 DMA and the 26 DMA. That's the line. You make one more line, which is actually the average of that line, and you see the crossovers there, which gives you the indications where the chart is showing you right now. Those blue areas are the indicators there. So that's just the technical bit of this. How you actually interpret it is what Dr. Narayan is going to tell you. Doc, what do you make of the MACD?
See, here I have a chart which is actually showing you both the 12 and 26 period, which you mentioned, as well as I have had it converted into a moving average convergence and divergence line. So your MACD line is out here. And this blue set of plots that you see is actually the distance between the MACD and its own trigger line. So what you have done is converted a two moving average system on the prices into something a little more complex, but which will reveal a lot more things to us in terms of where the stock is in terms of its trend strength, where is it ending by way of some set of patterns, where are the buy and sell signals, where do we take the set of profits. Everything is actually packed into this particular indicator. So it's an improvement on the moving average system as a whole. And if you learn it well, you will be able to use it much more effectively.
Well, that's what you see. It's a complicated indicator, but it's that line that you see and those blue areas out there. Those are the ones that tell you when to buy and when to sell. Those are the indicators for the MACD. How these actually apply on graphs, we'll get to that in a little bit right after this break.